Subject of the webinar suggests today we're going to be talking about perhaps the most important question on many of your minds, given the sort of rally that we've seen in the market, given the sort of appreciation you've seen in your CCP portfolios. A lot of you might have the question whether it's time to book profits or take some money off the table, and so on. So that'll be the primary motive and the subject for this conversation, along with an update on how CCP portfolio companies are performing. But towards the end of the call, we will also introduce an initiative which also goes towards addressing this query in some ways from an operational perspective. The question whether if you have a lump sum amount of money, should you put it all in one go or should you stagger it? We will talk about an option that we are providing to our investors, to our clients, which is the STP option or the systematic transfer plan. So, bear with us till that time, and we'll talk about the details. My colleague Nitesh is on the call. He's the pioneer on STP and PMSs. So we'll deal with the operational bits towards the end of the call. But for now, to kick off, I hand it over to Rakshit to take us through why profit booking doesn't make sense in the CCP context. Over to you, Rakshit.
Thanks, Pramod. Good evening, everyone. Thank you for dialing in. And let me just elaborate a bit on the context that Pramod briefly highlighted. So we all know markets are, as of today, I guess, markets are at all-time highs. So is our portfolio NAV. And the last 12 months, I think 12 months till date, Nifty has delivered something like 8-9%. Our portfolio has delivered around 25%, and most stocks in our portfolio are at their 52-week highs, actually all-time highs. And all this is happening when we are in the middle of a pandemic. At the end of the first quarter, the GDP growth was -24. There are fears of a second wave, so on and so forth, right? I think we all know that piece of the context. So hence the questions which we've been receiving, and hence thought of trying to address them through this webinar on the subject of profit booking per se. So let me quickly share a set of slides which will give you some perspective on how we are thinking about this. So to begin with, what are the intended benefits of profit booking when an investor does it, right? I thought deeply about it. I could come out with 3 broad categories. So category 1 is timing, right? Where there is a confidence, there is a belief that you can time entry exits and hence enhance your investment returns. So why not exit when you're sitting on a profit? Why not re-enter the sort of be greedy when others are fearful, and vice versa, so on and so forth. That's the first bit. The second bit is a possibility of trying to diversify at any point of time, where if you've had one asset class or one portfolio or one stock in a portfolio do exceptionally well compared to other options that you've been exposed to, then there is a very high probability that the top stocks or the top portfolios allocation will become too large for comfort. And hence, there is perhaps some merit in considering profit booking as a way to manage risk. And the third intended benefit that I could think about was the psychological one. It is in some ways, there's no mathematical or scientific logic to this piece, but I'll say it as I can see it in some of the questions, that look, if all our money stays invested at all points of time in the stock market, is that a better option, or should I just have some money in hand first, feel it, it's tangible, and then maybe I can reinvest later? That's as I said, there's no logic beyond the statement that I made, but yes, these are broadly speaking the three intended benefits. Now, according to us, especially the first and third one are totally, I would say, without any capability of delivering benefits to the investor. The second one, to a certain extent, makes sense, but even that that has to come with a lot of caution into the mind of an investor. So let's just go through the three one by one. Now, coming to the first bit, which is I can time entry exits. On this front, what we did was a simple exercise that we published in our 1st of November 2020 newsletter of Consistent Compounders. Hopefully many of you have already gone through it. So let me quickly just summarize the exercise that we did. In that exercise, what we did was we looked at companies from three different classifications, which we called as bucket A, B, and C. Where bucket A, which was sort of companies that delivered the weakest fundamentals in terms of revenue growth and returns on capital employed over a longer period of time, not just in the CAGR term being weak, even for say half of the 10-year period or half of the 20-year period, they didn't deliver an adequate return on capital or a healthy enough revenue growth. That we classified as bucket A. Finer details, you can always go back to the newsletter and see. Bucket B is where in half of a 10-20-year period, a company delivers respectable fundamentals, and in the second half, they don't deliver respectable fundamentals. And the two halves are not necessarily coming in lumps, as in you can always have a couple of years good, then 2 years bad, then 3 years good, then 5 years bad, etc. But it's relatively inconsistent, and on an average, the CAGR is sort of satisfactory, not great, in terms of revenue growth and return on capital. And bucket C is the top-notch quality bucket where fundamentals are not just healthy, they are also consistent over a period of time. As in, it's not just a CAGR which is a healthy one; it's also the consistency over a period of time, which is also similar to what you all are probably aware of is our approach in consistent compounder. So those are the buckets A, B, C, A being the worst in quality relatively, and C being the best. And then we define two types of investors. Investor one is Mr. Mortal, we named him like that, who doesn't know anything about timing entry exits. So all that he does is he enters with his annual investment corpus into equities at on the first day of every year, right? So let's say if he's looking at a financial year, on the 1st April of every year, he would invest his annual bonus and whatever savings that he's had over the last 12 months. Right? That's Mr. Mortal. He does that exercise year after year, and he believes that he cannot time entry exit. And Mr. Gifted is the other extreme, where Mr. Gifted has the hand of God in his head. He knows when will be a 52-week low during a 12-month period. And with that insight, he waits for the day when the 52-week low of a share price happens, and he invests at that 52-week low. Obviously, this is an exaggerated variant of what an investor can achieve, but yes, let's go for the Mr. Gifted, the most exaggerated variant of perfect timing of entry points, right? Now, if you were to do that on bucket A, B, and C, what you would see, and the table that is displayed here on the slide is of a typical Nifty 50, right? From a typical Nifty 50, and we analyze 2008 Nifty 50. If you do it on today's Nifty 50 or 2015's Nifty 50 constituents, the outcome will be very similar. Half of the stocks of the index fall in bucket A. For those half, the compounding that Mr. Mortal gets without any timing is suboptimal, which is 2% in this case for Nifty 50 of 2008 for the time period from 2008 to 2020, right? So we took the last 12 years, I think last 10 years. Last 10 years we took for Nifty 50 of 2008. And the outcome was that half of the index was in bucket A, and that index compounded for Mr. Mortal at only 2% CAGR. That's actually a hard fact for Nifty 50 at any point of time, right? That's what happens to the bottom half of stocks by quality. For that bucket, if you were the perfect timer of 52-week lows every year with your investments, instead of a 2% CAGR, you can actually achieve a more like a 9% CAGR, 8.5 to be precise, right? Now, the difference between 2 and 8.5 is not just big, which is 6.5%. It also meaningfully changes the nature of the outcome. So at 2%, you're not even compounding at your cost inflation. At 8.5%, you're just about meeting cost inflation, right? And so on and so forth. That's what we did then for bucket B and for bucket C. And what you can see here in the last column is that as you go up the quality ladder, the quantum differential reduces between Mr. Mortal and Mr. Gifted. More importantly, the nature of the outcome, it ceases to change between Mr. Mortal and Mr. Gifted. Right, so Mr. Mortal also compounds at a healthy rate for the highest quality stocks, and so does Mr. Gifted. Both are compounding their wealth at a satisfactory run rate, right? Which is not the case for bucket A. Right? Mr. Mortal, unacceptable run rate. Mr. Gifted, sort of getting into the satisfactory zone. So that's the outcome of that exercise. Now, why does this happen? If you look at the chart on the right side here, this happens because the weakest quality stocks, right, have an average compounding depicted by the dotted line here, have an average compounding of a very weak run rate, and they have a lot of volatility around that average, right? So if you look at the lower bar, the sine curve around it has high amplitude, right? And if the amplitude of the sine curve is very high around the average, then it makes a massive difference between 52-week highs and 52-week lows in terms of the impact it will have on your compounding. Whereas higher quality stocks, their long-term compounding happens at a decent pace. This is the line which is going upwards in the chart. And the sine curve around it is very low amplitude, right? Which means that whether you pick 52-week high or 52-week low, it doesn't deviate much from the average over a longer term, right? And hence, the outcome for Mr. Mortal and Mr. Gifted is very different from weaker quality fundamentals versus healthier quality fundamentals. So to conclude, you can do profit booking, but do it only if you are investing in relatively poor quality stocks, where probably the rally in the share price is not supported by fundamentals. Probably the rally in the share price is on a short-term basis the only way to make money there, rather than sticking to fundamental run rate of compounding. You actually need the share price compounding, the P multiple expansion to be there in your investment portfolio. And hence, for a bucket A, timing makes a significant difference. If you are booking profits in this environment on poor quality portfolios, poor quality stocks, you are at least intending to do the right thing. Now, whether you can do the right thing or not, I have my doubts, but at least the intent is correct. But if you're doing CCP or bucket C, right, then even the attempt has got no relevance, has got no justification, as long as your objective is to time entry exits, right? So that's conclusion number one. And again, as I pointed out, on 1st of November, we published this in the newsletter. This is the 2008 Nifty 50, the constituents of bucket A. You can see the return of Mr. Mortal, which is without timing, and the outperformance of Gifted over Mortal. And you can see how meaningful it is, especially for the weakest quality stocks, right? So it's quite interesting. It's inversely correlated. The column of Mr. Mortal's return is inversely correlated with the column of outperformance, and hence matters a lot in terms of timing. For poorer quality fundamentals, doesn't matter much in terms of timing for higher quality, right? And next slide has bucket C and Marcellus CCP. We've obviously got 11 stocks here, not all 13 of our portfolio, because 2 out of the 13 stocks, they were not listed for a time period longer than 3-4 years, and we did this exercise over the last 10 years. So that's something you should just bear in mind on the first objective of profit booking. It does not work in high quality companies, right? Second point, seeking diversification, right? Now, when it comes to diversification, the absence of profit booking in a portfolio over a longer period of time, right, can certainly lead to a single stock or a single product in your portfolio becoming too large for comfort, right? And hence you should certainly bear that risk management in mind around this subject. Diversification is the solution. However, bear in mind the following. If you diversify into an inferior quality substitute, right, you will have a massive drag on your overall wealth compounding run rate, right? This table quantifies it. So what this table shows you is that if you invested, let's say 1 crore at the beginning of a year and compounded that at 20% CAGR over a decade, and then redeemed the value, paid capital gains tax and brokerages, etc., your net CAGR would be the 18.8% column on the right, right? The moment you decide to redeem that money and invest it elsewhere at 20% CAGR itself, right? So let's say you exit from stock A, which compounds at 20% CAGR, redeem the money, invest it in stock B, right? If you do that with the profits of every year, and this exercise is only for profit booking, remember, we are not talking about the capital investment, only profit booking. If you do that, then your overall portfolio CAGR, just because of the expenses and capital gains tax acceleration over the time period, leads to the 18.8 becoming more like a 17.8. Now, this is a 100 basis point sacrifice that you might be willing to make if in exchange for this, you can reduce the risk of one stock or one PMS becoming 90% of your overall wealth, right? So that way is maybe you can decide to take the 100 basis points hit. But the challenge is, in most cases, substitutes are not of the same quality. And if substitutes are of inferior quality, we've quantified it at 10% CAGR. Mind you, 10% is not what Nifty has delivered over the last 5 years or 10 years. So if you invested in a relatively mediocre quality substitute within equities, right, you won't even get 10%. And outside of equities, there is no asset class which over the last 10, 20, 30 years has delivered a CAGR greater than say a 10% on average, right? So whichever substitute to go for, if you went for a far lower CAGR for the substitute with your profits booked on, let's take for example CCP or any other portfolio, then you are going to compromise on around 500 basis points of your investment performance, right? On the overall portfolio, this I'm talking about, right? That's how hard it becomes to then compound wealth at a rate substantially higher than your lifestyle cost, etc., so on and so forth. And that's where you can put on your wealth management hat or financial targets management hat, etc. But remember this maths, profit booking does not make sense if you are not 100% confident of the quality of the substitute in terms of the CAGR compounding, right? Diversification comes at a very big cost, which you might not want to take. Now, having said that, the first bit is when you look at a portfolio itself, right? At least I can talk about what we do at Marcellus. At Marcellus, we avoid a single stock allocation going up very high for a client by doing the rebalancing. So we are taking care of the diversification risk within a portfolio. But even if you were to go outside of the portfolio and say that, well, I can't just hold everything in one single portfolio, just remember that you have to hunt for substitutes which are also of good quality, right? And you have to obviously then trust them and all. So this is a point worth bearing in mind when you talk about diversification as an intended outcome of profit booking, right? I'm not saying it's not possible, but bear it in mind. And certainly people, I'm sure, can find sort of 30, 40 high quality stocks and stay equally balanced across 2, 3, 4 products, so on and so forth, whatever be the preference. So that's the second part. Now, the third part, which is a little, I mean, excuse me for maybe some sarcastic comments here, but it sounds a little funny. Why would you want money in hand when you don't need it to meet any expenses versus money in the stock market? I mean, I've sort of experienced this in areas where people say that, well, we don't know, the stock market can go to zero tomorrow. So let's just book everything, get a feel of it, and then maybe we can go back in again. I mean, there are such arguments. But just to understand why this is actually a not so rewarding way to think about it, right? I would say, think of it like this: there are three types of examples that you can consider and then evaluate. Example number one is look at, let's say, real estate as an asset class. Now, the interesting thing about real estate is that you don't get to know the value of real estate on a daily basis, right? So you don't know whether you're sitting on profit or not, right? So if US elections are happening, what happens to your real estate price? You don't know, right? That's one challenge with real estate. Mark to market doesn't happen on a minute by minute basis. Plus, the volatility in the value of real estate is not very high. I mean, you can go up or down maybe 20-30% in a year, but it's unlikely that real estate will suddenly go down 95% in a year, despite the fact that there has been no earthquake which has brought the house down or something. And it is rarely the case that within a 6-month period, real estate will give you a 5-bagger return or whatever, right? So in that way, real estate is less volatile, and you don't get to know about the mark-to-market profits, unrealized profits in your real estate investments on a daily basis, on a minute-by-minute basis. As a result, profit booking obviously doesn't make sense for an investor in real estate, and hence you don't find people. Fortunately, you don't find people who bought a very good property at a very right point of time, and hence it was a great asset. But then 3 years later, let's say if it was a 3-bedroom apartment, they sold 1 bedroom to book profits. And another 3 years later, they sold the 2nd bedroom, and then the kitchen, then the bathroom. And then 20 years down the line, you don't see the challenge of investors sitting with 1 square feet of a great asset after having bought 2,000 square feet 20 years ago, right? That doesn't happen, thankfully, because you cannot do profit booking. But if you were to do profit booking, that's a risk in a way that real estate investments run, even if you pick up the right investment. Right now, consider the polar opposite of this, which is, let's say, gambling. Right. So you go to Goa in a casino, or let's say Las Vegas, wherever. Now, the difference between real estate and gambling is, in gambling, you can know your mark to market on a second by second or minute by minute basis, right? In a casino. Plus, the volatility is very high, to the extent that there is no fundamental reason why you should say I'm downside protected, even in the worst case scenario. Right? Even in the worst case scenario here, you might say that I'm gambling. If hell breaks loose, I might lose everything that I have on the table in front of me. Right? So that's gambling for you, and hence, if you are playing on pure luck, it might actually make sense to say that when you have some unrealized profit, right? Book it, keep it in your pocket, secure your capital, and then everything else you can put to risk. Right? That's a way to approach the psychology of not being invested at all points of time and having money in hand. When you're gambling, it makes sense. Actually, if I were to go to Goa and I have lost money every time, but if I were winning it ever, then I would have certainly done that. If I enter with 10,000 rupees into a casino, I would first try to make 10,000 rupees as a realized profit, and then have fun with the rest of it. Right? That's gambling for you. You're playing on pure luck. Interestingly, even if you are the best gambler, gambling is not a consistent wealth compounding engine. Right? Nobody compounds wealth, and why don't we do it? Because of this particular reason, right? You cannot have a fundamental reason to stay invested in a high quality asset and derive consistency of healthy compounding over a longer period of time, right? That's not gambling for you, and hence gambling is not for wealth compounding. Now, as a result, when you look at equities, when you look at your portfolio, whether it be with a particular product, whether it be direct equities, whether it be one stock, several stocks, whatever it is, when you look at equities and consider profit booking, you have to evaluate luck versus fundamentals very clearly in your mind, right? If you believe you are playing with pure luck, you don't have any clue whether there is a difference between a Yes Bank and an HDFC Bank or not. You have no clue whether Nifty is a high quality index or not, right? You have no clue whether there is difference between a 5% return on capital company versus a 30% return on capital. If you have no clue about all of that, there is no fundamental reason for investing in a particular product or a stock, etc. You have no trust in the fund manager or whatever be the reason. If you're playing on pure luck in equities, it makes sense to do what you're doing in the gambling scenario. But remember, if you're doing that, you're not there for wealth compounding. You're probably playing on luck and probably having fun, and yeah, maybe you protect your capital, make some money, and have a joyride. But for wealth compounding, right, it has to be a lot more tangible, fundamental reason why you have invested. And if that reason exists, hasn't changed, it doesn't mean you start booking profits just so that you get some money in your hand, right? So that's how I would sort of come up with an explanation to that psychological challenge. Now, moving forward, if you then look at what happens when you attempt profit booking, right, or market timing, whatever you call it, what happens, there are, I'll just take you through 3 or 4 slides, very interesting ones, and you should do this with all portfolios that you have. We can obviously just show you Marcellus, CCP, or the stocks that we know well. This chart shows you a bell curve, right, where since inception, the NAV of Marcellus CCP has been mapped onto this chart for 2 time periods. First time period is a 3-month time period, which is a short one, right? 3 months is too short. And in 3 months, even if you try to time entry exits, it's very difficult, I would say practically impossible, to change your mind from a complete selling and exiting mode to a complete repurchase mode. 3 months is a relatively shorter period of time. Somebody who's trying to time entry exits doesn't time it over a 2, 3, 4 week period, both entry as well as exit, right? In investing, not in speculating or trading. And hence, what is probably more important to look at is maybe a 12-month curve, because even if we are trying to successfully attempt profit booking or market timing, I think the entry exit is spread across a 6-12 month window. It is not spread across a 2-3 month window, right? So if you look at a 12-month window, this is the steeper bell curve that you see, right, with a bigger height and narrower bottom. This bell curve shows that on an annualized performance basis, and we've done this on a weekly rolling basis, Marcellus CCP at least has not delivered negative return even once for any 12-month period since inception, right? So the way to look at it is, what we've done here is 1st December 2018, for instance, we started. So 1st December 18 to 1st December 19, then 8th December 18 to 8th December 19, 15th December 18 to 15th December 19, like that. Right? So these are the weekly 12-month time periods we've taken. Every dot that you see on the curve is 1 data point for a 12-month period. Likewise, every dot that you see on the 3-month curve is 1 data point, right? Over a 3-month period, the annualized return has varied between sort of -80 and +100. And it is not all collected in a very narrow band, and hence the height of the curve is low. Whereas when you look at the 12-month period, they are all accumulated together, right? And you can very interestingly see the 20% number is where it peaks. The maximum number, the maximum frequency of outcomes is the 20% outcome. We haven't had a more than 40%. We haven't had a less than 0, right? So that's the bell curve here, which sort of tells you that it has been futile trying to time CCP type of a portfolio over the last couple of years, assuming you will take 12 months to decide on entry and exit points, right? Obviously, if you are capable enough to time entry and exit both within a 3-month window, there are several opportunities out there. But I think that's for many of us, it might not be possible. So that's a very interesting message coming out from this one. The same you can actually assimilate from this chart, right? So let me first explain how to read this chart. This is slide number 9 I'm on. This chart has 3 things. Vertical bars show you the trailing 12-month return of Marcellus CCP, right? This chart we've done for Marcellus CCP. In the next slide, I'll generalize it and take a stock example over a longer period of time. So the vertical bars are trailing 12-month returns from Marcellus CCP. The line chart is the NAV at any point of time for Marcellus CCP, right? So for instance, let's take the lowest point, right? Lowest point. I hope you can see my cursor. If you can't, then I'm talking about the lowest point on the line chart. Lowest point on the line chart is of 4th April 2020 timestamp. On that timestamp, the previous 12-month return from Marcellus was something like, I think, 2-3-4%, or it was a low single-digit return, right? Maybe 1%, whatever. That's the vertical bar, right? The NAV is depicted by the line chart at that point of time, right? And hence the line chart shows you what happens to your performance if you stay invested by looking at the trajectory of the line thereafter, right? So let's say you take a peak of, say, February 2020, when the line chart peaked. The performance in the preceding 12-month period was 40%. If you had stayed invested, today, your NAV has gone up from around 14 rupees to more like a 16 rupees, right? So your NAV is roughly up by around 10-15%, or I think a little higher, from the highs of Feb. If you take, let's say, any point on this chart, that's the way to read it, right? Now, the third variable, in addition to the NAV line and the trailing 12-month performance, third variable is the event which keeps happening on the timestamp, right? And there are lots of events. I'm sure people who've been invested in the market, they know. I mean, now we are in November. I think 1 month from now, everybody will be talking about what's going to happen in budget, right? Because budget will be 1 month away. 1 month back, people were talking about US election. 3 months back, I remember there was a weekend when the news came that multi-cap funds are going to do something and small cap funds are going to do something, and there's going to be a big shift, multi to small or small to multi, and markets are going to go haywire, this, that, or the other, right? And these things keep happening, and we've sort of put some events here, but at any point of time, these events on a rolling basis keep coming through, and that's how human mind works. We always remain in a mode of either panic or euphoria when it comes to what's happening around us. So when you consider the 3 points, which is at any point of time, there will be a reason to panic. At any point of time, you will be sitting on a healthy historical performance. And at any point of time, if you stayed invested, the subsequent line chart is going up, right? If you combine those 3 things together, you will see that over the last couple of years, booking profits by looking at the profit that you are sitting on unrealized and the event that you are facing, basis which maybe you are worried about the future, booking profits has never really made true sense, right? So that's a message from this. If you, and obviously, I mean, this chart is only for a 2 year period, and 2 year is short. 2 year is specific to only Marcellus. So let's just look at a much longer period. Slide number 10 here shows you what would happen to an Asian Paints if you were to do the same thing, right? The vertical bars are the trailing 12-month return of Asian Paints' stock, right? All these things you can quickly read by yourself. At any point of time, you would be either worried about the PE multiple, 52-week highs, the crude oil price, some acquisitions that Asian Paints did, some news flow that the promoters are fighting, some news that there's been a capacity expansion from competition. Maybe the promoter family members have resigned, and you saw a lot of that over the last 12-13 years, right? It just does not stop. The reason why you should exit from Asian Paints, book profits, seek a lower entry point, that reason just keeps coming with a very good frequency, right? But the interesting point is, despite the fact that you always sit on a profit on the trailing 12-month basis, and there is always a reason to book profits, the line chart of Asian Paints shows you that the subsequent period would have always given you higher and higher returns, right? This happens basically because it's a consistent compounder. If you're compounding fundamentals consistently over a longer period of time, these events, which the fundamentals have already made redundant, these events will have no bearing on the share price. And hence your decision to compound, book profits or time entry exits is always going to be futile. And this is the reason why, going back to the Mr. Mortal, Mr. Gifted exercise, the difference between Mr. Mortal and Mr. Gifted for bucket C or for CCP companies is very narrow, right? This is not the way a chart would look for a bucket A company, right? And the names are there. You can build charts very easily. It will now, so profit booking will make sense for bucket A, but not for bucket C, right? So that's there. Now, having said that, coming to the last bit, which is, I'm sure after going through all these charts, people will say, well, all this is sort of intellectual stuff, looking in the rear view mirror and analyzing history and all. But we are in the middle of a crisis, that to a pandemic. It hasn't happened in the last 100 years in this sort of an intensity. We've not had GDP growth -24, etc. Right? So this is what we are dealing with right now. In the second quarter of a pandemic like this, our portfolio companies, and I've put up the non-financials stocks here. For financials with a 3-month lag, you will see exactly the same thing, right? The non-financial piece, you can see what their revenue growth was, very healthy, right? What their PBT growth was, exceptionally healthy, right? Most importantly, from June till October, right? The momentum of revenue growth volume has only been getting better and better and better. And hence, the September-October run rate, interestingly, is in double digit for all the companies, literally all the companies. For Dr. Lal PathLabs, which we've mentioned, sort of close to 100%. If you include COVID, even that is at comfortably above 20%, right? So in that way, we are actually experiencing in a very perverse manner benefits of a crisis playing out for our portfolio companies. And the reasons for all of these companies delivering healthy performance is the last column, which is market share gains. It is not that the paint industry is growing. It is not that the diagnostic industry is growing. It is not that the food industry is growing, right? Nestle is gaining from unorganized food players. Asian Paints is gaining from Nerolac, AkzoNobel, and unorganized players. Divi's Labs is gaining from substitution effects from other countries to India on API manufacturing and a few other things. So is Dr. Lal, so on and so forth, right? So this is central to the resilience of fundamentals and hence resilience of share prices, even in a pandemic. If you ignore this, then you will be wrong in booking profits, hoping that you will find a equally good substitute elsewhere. More importantly, hoping that you will re-enter the high quality stocks again at a lower price, right? Lower price might happen 2 weeks down the line. We might be sitting on a -30% or -20% on certain stocks. But the point is, you will not be able to time entry exits because the window will be very narrow and the resilience will be very, very good, right? And this is not happening only in the pandemic. Last 5 years, interestingly, have not been too different, right? This is a slide which I'm sure many of you who've gone through our previous webinars have seen. This slide talks about a table on the right. Just look at the table on the right. Table on the left is just an outcome. Table on the right, which is the input to a share price, is the fundamental. Last 1 year, 3 year, 5 year. Look at the bottom 2 rows. Nifty 50 has not compounded at all. Our portfolio companies have compounded at a healthy pace. This is only for financial year. Doesn't include the last 6-7 months. Last 6-7 months have not been weaker than this. They have been actually stronger than this. So let's not get confused between the relevance of last 5 years in the current environment when we are facing a pandemic which didn't exist in the last 5 years, right? That's not the case. So that's how I would put it. And hence, just like over the last 5 years, booking profits was a mistake. Timing entry exit was a mistake in the highest quality stocks. The same applies here, right? Whether it be our portfolio or somebody else's portfolio, if it's high quality, booking profits and timing entry exits is a mistake, right? So that's a message. This is a simple performance. Towards the end of this month, you will get the you'll get the newsletter numbers as well. But this is as of yesterday. And in particular, look at the last 12 months performance. Last 12 months, table on the chart on the left, Nifty has delivered around 10% total return, including dividends, and we've delivered around 26, right? So that's why probably the question of profit booking comes. You're sitting on 20%, 26% profit, and hence should you wait for a lower entry point? The answer is no, right? A very highly confident no. So that's how I would summarize it. And now over to Nitesh. Nitesh, do you want to just talk about STP? You can just ask me to do the next click and I'll do it.
Yeah, sure. So you can click it, Rakshit. Thank you so much. So, as explained by Rakshit, at Marcellus, we don't try to time the market for the simple reason we have no ability to time the market, and we deploy the entire money as soon as we receive it. But having said that, we do understand in short term, there might be, emotional pain for clients because of events like what happened in March. You give us money and we immediately deploy everything and market corrects. And so in short term, there might be pain. And hence, considering that, we have launched a STP plan, which is systematic transfer plan, where client can invest money spread across 5 months. It's a plain vanilla option where money will be deployed across 5 months. For more details, we have prepared an FAQs and it is uploaded on our website. Request all the interested people to go through our visit our website and go through it. In simple terms, I will tell you how STP works or how it will work. So you give us 100 rupee. On day one, we will take 20%, that's 20 rupee, and we will straight away deploy in the equity market. Balance 80%, which is 80 rupee, we will put it in liquid funds. It's HDFC overnight fund where we will park your money. And then every month on 20th, we will transfer 20%, that's 20 rupee from liquid STP to equity PMS. So over 5 months, we will deploy entire 100 rupee in the market. So this is the only option of the options available. 20% every month across 5 months. So in the table below, you can see the example, simple example what we have tried to show. So if someone gives us 50 lakh on 1st December, 10 lakh is immediately deployed in equity market and 40 lakhs will be deployed in the STP fund. And then every month, next month around 20th, every month we will transfer 10 lakh and it will be deployed. So over 5 months, money will be deployed. For STP, we will be charging a fees. The fees, if we calculate on rough cut basis, it will come to some 0.3 to 0.4%. You can think of this cost as a cost of staggering. You want to take that option of stagger your money, and that is the staggering cost. So between 0.3 to 0.4, that will come to some 16,000 rupee for your 50 lakh rupee portfolio. If you guys have any further queries, feel free to reach out to us. Please go through the FAQs, and we will be more than happy to answer any other query on STP. So, Pramod, we can take Q&A.
Sure. So Rakshit, I think the first question, I think there is a common question across several investors. It's about the investment horizon. So one is just to clarify the first slide that you've shown, the doctor, Mr. Mortal versus Mr. Gifted. Over what horizon have you taken that analysis? Does it apply across horizons? Because people might have different horizons on which they're making this investment. Worth clarifying that up front. And once you clarify, I have a few corollary questions around it.
Yeah, sure. So let me clarify 2 or 3 things in this analysis. One, this we did for a recurring investment, right? Which is you invest 100 rupees each year and you do that for a 10-year period, right? So the time period that we've taken here is a 10-year period. Over a 10-year period, this is the outcome that you get on the CAGR of the product for the 10-year period. CAGR of the stock for the 10-year period. If you were to do this as a bullet investment, right? As in, instead of say that every year I will deploy 100 rupees. If you were to say that, okay, let me deploy at the beginning of the year and hold it untouched for a decade, right? The outcome will be exactly the same, right? That actually, in some ways, there are various ways in which we've depicted this in the past. One way is to just look at, let's say, the back-tested portfolios that we've published in our books, where you do a bullet point investment in such a portfolio, whether you do it at the peak of 2008 or at the bottom of 2009, whether you do it at the peak of 2000 or after the crash of the dot-com bubble bust, right? It does not matter. Your 10-year CAGR is unchanged at around 25% plus minus 2-3 percentage points, right? So regardless of whether you do bullet or recurring for a 10-year period, this is the outcome. That's one way to understand it. Second bit is, this is a 10-year analysis. If you were to do it as a 3 or a 5-year, the outcome will still be the same. And for this, I would actually point you towards, again, for those of you who've read some of the books that we've published in the past.
So Rakshit, I have the page reference from Coffee Can Investing.
So there's that bubble chart.
Yes. So I was saying Exhibit 7, page 36 of Coffee Can Investing. So those who haven't read the book, please buy it and read it. Rakshit and I wrote the book a couple of years back. It's the largest selling book on investing written by Indians for the Indian market. So the point Rakshit is making is nicely illustrated both in the book, actually also in Rakshit's slides here. So what we have shown on page 36 of the book is, if you take the last 17, 18 years of data crunch, whether you take a 1-year period, a 3-year period, a 5-year period, or a 10-year period, the typical outcome that you are getting with this style of investing, and we've shown this very clearly in Exhibit 7, page 36, the typical outcome you're getting is returns in the low 20s, mid 20s in rupee terms, right? So typical outcome, most likely outcome, returns in the low 20s, mid 20s, whether you're taking a 1-year, 3-year, 5-year, 10-year horizon. Even more interestingly, for those who are worried about negative returns and profit taking and so on, if you take anything longer than a 3-year outcome, we have shown that using the last 20 years of data, if you take longer than a 3-year horizon, you do not suffer negative returns. The other way to get the same message is, Rakshit, just move to that distribution wala slide, the one where you've shown the distribution. Bell curve. Okay. Right. So this is actual data, right? So what Rakshit is showing you in slide 8 here, these bell curves are actual CCP returns from the day we started managing this, which is 1st December 2018. So if you look at the orange or the brown bell curve, the more spiky bell curve, right? Those are 12-month returns. So that's saying that somebody who takes a 12-month horizon, somebody who's willing to buy and stay with us for 12 months, the most likely outcome this is showing you is 20% returns. And as it says, and it shows on that chart, there is no 12-month horizon in which our real returns, our realized returns, there is not a single 12-month horizon in which we've given you a negative return over a 12-month horizon. So our submission to you, both using real data from actual CCP performance in the last couple of years, and from what we have written in our book, Coffee Can Investing, is that even if you take a 12-month horizon, your most likely return outcome is low 20s, and the chances of losing money, both theoretically as per the book and practically as per that brown line, the spiky chart, the chances of losing money are close to 0.
Yeah. So one question is, while CCP has a 4-year horizon, and of course, lots of other things that have happened in history may not have happened in this 4-year period. One specific question is, how long would CCP take to recover its losses if 2008 were to happen again, where GFC were to happen again? How long did it take, the robotic portfolio, CCP portfolio, take to recover its losses? A similar question, I think it'll be a corollary again, is if I were to invest with a 3-year horizon, what will be the worst case returns on a 3-year horizon? And one question specifically from one of our senior citizen clients, he says, both me and my wife are in our 70s. Of course, we don't have the luxury of a 40, 50-year-old. Would I, obviously a 10-year horizon doesn't make sense for me. And would a similar analysis apply to my own investment horizon as well?
So Rakshit, why don't you go to that NAV wala slide and you can show how quickly CCP recovered from COVID. So COVID is our kind of this decade's Lehman, and then I'll dig out the Lehman data from the book.
Yeah.
Because the NAV, the CCP NAV, we can clearly see how quickly the CCP NAV, just put it on full screen and
Yeah, so you can see from the line chart here, line in that chart here, the recovery back to pre-crash levels happened by mid-August, right? More or less. By the way, it depends on how you define as pre-crash. So the Nifty peaked on 14th of January, right? So if you look at the 14th January peak, we recovered by mid-August because that's when the markets peaked. Our portfolio peaked in mid-Feb. We talk about mid-Feb, the recovery happened by mid-October and end October, right? What happened to the market? The market doesn't recover so quickly. The recovery for the market, so market peaked in mid-Jan, right? Which was about 1 month before our portfolio peaked. And the recovery to all-time market highs happened last week, I think, or this week or today. I don't know, something like that. So we are in that way, it's a much quicker recovery. More importantly, the drawdown was 1/3 for our portfolio compared to the market, right? So the market fell from peak to trough by around 40%. We fell from peak to trough by around 15%, 1/5, right? 1st Jan to 31st March, market was down 29-30%. We were down 12%, something like that. So the drawdown was 1/3 that of the market, and the recovery was in 60-70% of the time period that the market took. That's from the COVID crash. Now, I mean, I was just trying to go to that slides deck. Maybe I can do that whilst we answer more questions. We did an analysis in one of our webinars that we did on 23rd of November, the 23rd of March, the day when actually we were interestingly doing a webinar on the day when the market fell by 15%. In that webinar, we showed that the CCP backtested portfolios, right, after the market bottomed out in March 2009, the CCP backtested portfolios recovered to Jan 08 levels within 5 to 6 months, right? Some stocks within 3 months, some 5 to 6 months. I am repeating again. After March 09, which was the bottom, the CCP portfolios recovered back to Jan 08 levels, which were the top, within 5 to 6 months. The market recovered after 20 months, 20. Right? So market recovered back to Jan 08 levels only in November 2010, which was 20 months after March 2009.
If you stop sharing from your
Right?
side, I'll
so
share
that's the
slide.
difference between the pace of CCPs versus the market.
Rakshit, if you stop the share from your slide, I'll share that slide.
Just to clarify what Rakshit is saying. So Rakshit, between Jan 08 and March 09, that's 14 months plus another 5-6 months. So you're saying that anybody who put their money at an all-time high of Jan 08 into CCP saw negative returns for 14 plus 5 to 6, say 20 months. Is that understanding right?
That's right.
But the same thing for the market is close to 3 years.
34 months. Yeah.
Close to 3 years. All right.
Yeah.
Sorry, Saurabh, go ahead.
Yeah, so just going to share the same slide, just showing this point, right? So if you take, one second, let me just get the share going here. Can you see the slide?
Yeah.
So if you see Sensex pre 2008 and bottom of the crash, Sensex lost 70% of its value, right? CCP lost almost half the value of the Sensex, right? So CCP loses. So, and remember, this is the robotic CCP. The CCP that we are referring to in this slide is the robotic CCP, where you're just using the filters that are described in this book. Even that robotic portfolio with no human intervention lost half the value that the index lost, the Nifty or the Sensex lost. And because your drawdown is so much lower, right? And we saw that again this year, January, February, March, the Nifty fell 30%, CCP fell 12.9%. So once again, history repeated itself, which was why on that March conference call that Rakshit is referring to, we were so confident that we would come back strong. We could see that the market we had fallen less than half as much as the market, which explains why we recover so much quicker than the market. So this validates Rakshit's point on ABC, right? If you've got an A style portfolio, you've got type A portfolio, which is a typical Nifty style portfolio, you will fall sharply. And if any of you have the skills to time the Nifty, then you are very lucky. If you can time the Nifty, you'll outperform a typical Indian mutual fund manager by a huge amount. So which is why Rakshit says, if you have a mediocre quality company, or if you have a Nifty style portfolio, a typical large cap MF portfolio, market timing does make a lot of sense, right? Because if you can invest at the bottom of the Lehman crash, bottom of the crash was March 2009. If you had bought the Nifty, or if you bought a large cap mutual fund on 2nd March 2009, and you had sold, say, January this year, your compounding over that 11-year period would be around 20-21%, almost CCP-esque compounding, right? Where you get in right at the bottom of the Lehman crash, say 4th, 5th March or 2nd March 2009, you sell in January 2020, you're God, you can compound at 20%. That's the equivalent of stock type, bucket A in Rakshit's jargon. But if you don't have such godlike characteristics, if you don't have such insane insight on when to buy, when to sell, your straightforward way to compound at healthy numbers, 20% compounding, is to do the CCP portfolio, which is exactly what we are trying to do here.
Okay, I think that's quite clear. Just an element of fundamentals, Rakshit. I think there are a few questions around earnings performance, because seems like the most often talked about statement is markets are disconnected with fundamentals and so on. Can we just give a sense of how CCP stocks have performed in terms of earnings? I think we showed that in the last webinar. Maybe you want to pull up those slides as well, just to give a sense of stock price performance versus earnings performance over the relatively longer term period, like 3 years.
Yeah. So so this is the slide number 12 is the longer term variant, where table on the right shows you FY20 profit after tax for all the 13 stocks that we hold in our portfolio, and the weighted average in the second last row at the bottom, and then Nifty 50 profit after tax for FY20, and then the 3-year period 17 to 20, and the 5-year period 15 to 20. Right now, last 5 years, somebody looking at Nifty would say that last 5 years were actually pretty bad. I mean, some might say that this is worse than the last 5 years, but no. Last 5 years, Nifty had zero earnings growth, absolutely zero, over a 5-year CAGR. We are not talking about 6 months here, and that was obviously because of GST, demonetization, island FS crisis, variety of other things, and COVID now, which affected FY20 as well, right? So when you look at 1 year, 3 year, 5 year, there was just no earnings growth for Nifty. For our portfolio companies, not only was the weighted average healthy, the spread across all stocks was also pretty healthy. So the weighted average was not pulled up by 2 or 3 stocks, right? It was actually healthy across the board. And that too, not just for 1 year, which pulled up the 5-year average. It was the same for 1, 3, and 5 years, right? So pretty consistent across stocks, across time periods for our portfolio, and pretty healthy, versus Nifty 50, inconsistent, unhealthy, etc. That obviously then translated into the share prices, which is table on the left. This table on the left is for the financial year, 1st April to 31st March. This does not include the recovery in markets and our portfolio over the last 8 months, right? Doesn't include that. And you can see the delta. So even if you include the last 8 months of recovery, the Nifty 55-year CAGR becomes more like a 3 to 4%, right? Our portfolio CAGR becomes more like a 24, 25%, right? Because when you look at, let's say, our since inception return, you can see the 26%, right? Since inception. Over the same time frame, for Nifty 50, it is more like a 10. But that's also because our inception was only 2 years. Over a 5-year period, Nifty has delivered mid-single digit, right? Versus our portfolio pretty healthy. Now, over the last 5 years, when Nifty delivered 5%, there were several points when you could have booked profit, re-entered, and enhanced your outcome. But that didn't apply to our portfolio companies, the share price individually or weighted average at a portfolio level, right? So that's the message.
Fair enough. And of course, our favorite question in terms of, given this, agreed there is no merit in timing it, but aren't CCP stocks overvalued?
Right. So I'm sure many of you are aware of this, but let me just reiterate. If you are looking at the drivers of a share price, they are broadly two, right? Change in the P multiple and change in the earnings. And this is simply because mathematically speaking, price is equal to P by E into E, right? So in a simplistic manner, obviously this is not accurate maths, but in a simplistic manner, if you add up the percentages of P by E and E, you will get change in price, right? Now, if your earnings compounding is weak, and as I showed you few slides back, bucket A delivered an earnings compounding of 0. That's why the share price also was 0. Whether you look at last 10 years, last 15 years, last 5 years, Nifty earnings is 0, right? So finding 0 earnings compounding is not difficult in the stock market. It's very easy. It's prevalent everywhere. You pick up a stock, there's a 70-80% probability there will be 0 earnings compounding, right? So when you pick up 0 earnings in the equation, you are left with only P multiple to play with. And the only way to play P multiple is profit book, re-enter at low. Profit book, re-enter at low, because P multiple doesn't continue going up, compounding for over long periods of time, right? P multiple oscillates between sort of doubling, halving. Nifty P is between 13, 14 times at the bottom and 28, 30 at the top. And for every stock, there's more or less a doubling, halving at max 3x, 1/3. If P multiple doesn't compound, earnings is 0. The only way to make money out of 80% of the stock market is by profit booking and re-entry. So the approach works. It does work, obviously, provided you can execute it well, but it works in helping you enhance your returns. It does not matter on CCP types of stocks, where if your compounding of earnings in the normal environment is 25, right? And by the way, if last 5 years we've delivered 19, 20%, when last 5 years were subnormal, right? Then we are still in the zone of sort of 20-25% CAGR for high quality companies. They are not saturated, they are not disrupted, etc. So if you are in the zone of 20-25% earnings, the only thing that the P multiple can do is change the quantum of your compounding, not the nature of compounding. Your nature of compounding will still remain very healthy, even in the worst case scenario, which is close to, let's say, 18-20%. Add dividend 1, 2, 3%, whatever you want on top, 1 or 2% dividend. It is actually 20% in the worst case scenario of this equation, right? So in that way, valuations don't matter. Now, you can change the time period. This equation we've used for a 10-year investment horizon. You can reduce it to 5 years or 3 years. Even for a 5-year investment horizon, the equation will be plus minus 11-12% versus 25 for earnings, right? So plus minus 11-12 from the PE, 25 from the earnings, and the band of outcome will become 15% at the bottom, 35% at the top for a 25% earnings compounding, right? So even if you take shorter time horizons, this this equation applies. And remember, whenever the PE multiple of a 25% earnings compounder has halved, it has been a temporary halving. It is very difficult to see the PE multiple of a Bajaj Finance halve and remain at half despite Bajaj Finance compounding at 25% plus, right? That doesn't happen. So from a long-term basis, it is theoretical to see PE multiple halving across the portfolio and remain at the lower level for a longer period of time. But even if it were to happen, the worst case scenario is not too bad.
So let me just take a children example. While Rakshit was explaining the ABC, I was thinking of my kids. And let me just use a children example analogy to explain this ABC point more clearly. So I've got two kids who are in their early teens. So let's take my daughter. Assume for a minute that for the last 6 years, she's come first in our class, right? My hope is that my daughter is a C's for CCP, that she's in class 6, 7. Hopefully she'll keep coming first in class. And if she keeps coming first in class, my hope is that one day, like Rakshit Pramod, she'll go to IIT, IIM. Right? So my view is that my daughter is a C, she's a CCP. And therefore I will invest whatever I can, my wife can, in her education, giving her vitamins in the morning and carrot juice and whatever, so that she keeps compounding. She keeps compounding, keeps coming first and goes to IIT, IIM and, builds a successful life for herself, right? I'm not going to say, my God, she's come first 3 years in a row. Let me now cut her education, get her out of school because, she's done too much. The price has run up too much. Let me take profits on my daughter's education. I'm not going to do that, right? I'll be crazy to do that. Now, let's assume for a minute that rather than my daughter is a C, assume for a minute my son is an A. He's an A for airlines. That he's not coming first. He's coming, say, 15th in his class or 20th in his class. And that's the way it's been for 6, 7, 8 years. The compounding simply isn't there. I'm not going to say, well, COVID has happened. Let me reinvest even more in my son's education, right? Because I know that, in this case, the compounding isn't there and I need to be realistic about it, right? So I'm sure everybody who's on the Zoom call is equally realistic about their children's education. They want their children to do well in life. And, once your child is 13, 14, 15, 16 years of age, you've got a pretty good sense whether he or she is a B or C. If your child has been a C for 5, 10, 15 years, you don't suddenly stop investing in her education. You don't take profits. You reinvest even further because you want your child to do really well in life, right? And similarly, if you've seen that your son or daughter doesn't really have the aptitude for, going to IIT, IIM, you try something else with them. You don't reinvest even further in sending them to IIT, IIM. Now, all of us find this very intuitive when it comes to children, but for some reason, in the stock market, people get their heads screwed the wrong way around. They're seeing Asian Paints do well year after year. Rakshit writes about it every month. We've written books about it. And yet they want to take profits on Asian Paints. They've seen the vast majority of the Nifty deliver no compounding in terms of earnings over the last 10 years. And yet after COVID, they're loading up on the same old rubbish, which is that A is for airlines category, right? So if only we could take the common sense behavior that we apply to rearing our children and apply it to the stock market, we would all become better investors.
Great. Just one clarification, Rakshit, you mentioned the 25% growth and you also acknowledged that the last 5-year growth for CCP has been 19% due to suboptimal economic conditions. Would you care to elaborate what those suboptimal economic conditions were over the last 5 years and why we should believe that's likely to change in the next 5 years?
Okay, sure. So what is CCP constituted of, right? When you look at these stocks, look at this list, right? This is the list which is at the center of GST. This is the list which was at the center of demonetization. This is the list of stocks which was at the heart of COVID, right? Obviously, the whole economy was at the heart of COVID when it was a lockdown. But after the lockdown opened, right, job losses, etc., it affects consumption, especially discretionary consumption, in a meaningful manner, right? Demonetization the view was that people get their walls painted because there was extra cash lying in the wardrobe. Now that is not going to be happening, and hence we will see a massive deterioration. GST, I mean, the whole channel got disrupted. Every firm in this table uses distributors, wholesalers, obviously barring Asian Paints, but even Asian Paints uses dealers, right? And the channel partners were hammered by GST, not on the business they were doing with these companies, but on the business they were doing with other companies beyond the organized players. And India is a largely unorganized market, right? So those are some examples, but last 5 years, we saw 0% Nifty earning CAGR because it was an abnormally disruptive macro environment. Right. Obviously, the other extreme is look at the 2008 to 13 period, which was MG Narega, right? The Mahatma Gandhi NREGA program. In that period, Unilever used to grow volumes at 13-14% CAGR for 5 years. I mean, this is Unilever in soaps, detergents, oral care, which are 97% penetrated categories, even in rural. In that category, Unilever was growing volumes by double digit, right? So that was a time period when consumption was on steroids in India. Last 5 years was a time period when consumption was disrupted. The long-term CAGR is somewhere in the middle, and that's where the sort of 5% shave off versus the average that has happened over the last 5 years to our portfolio companies, given the external macro, has to be borne in mind. Now, do we expect every year a GST, a demonetization, a black swan event, and these are all black swans, they all affected consumption. Do we expect them to continue happening? I think probably not. Even if they do, the worst case scenario is that these companies, as I said, they benefit in a perverse manner from every crisis. That's why they've delivered a 20% in the last 5 years. That's what they will probably deliver over the next 5 years. India is not saturated in consumption. India is not saturated in penetration of any of our companies is macro, right? So that's the reason why I mentioned 20 was probably the worst case scenario.
Thanks, Rakshit. So sort of question to you, whilst this is a CCP webinar, there are questions. Would this sort of, irrespective of time in the market, apply to KCP and Little Champs as well? For everybody's understanding, Kings of Capital is our newly launched financials portfolio, which has performed well in the recent past. Similarly, Little Champs, which is more than a year old, has also performed very well. Does the concept of booking profits not apply here, or are they much like CCP as well?
So all of our portfolios, right, are built on the same philosophy, and the philosophy that I'm sure everybody on this call has heard hundreds of times, which is we're looking for companies whose books are clean, accounts are clean. We're looking for companies who are selling essential products, services, whether they be B2B or B2C. And thirdly, we're looking for companies with very high barriers to entry, right? So whether it is KCP, CCP, LCP, this three-pronged framework is what we are applying day after day, portfolio after portfolio. And actually, for exactly these three reasons, the other two portfolios have also done extremely well at what is clearly, and we have to concede, what is clearly a time of broader economic distress. I'm sure there are people on this call like myself who have lost friends and relatives in this pandemic. There must be people on this call who've seen their loved ones lose their jobs, perhaps their livelihoods. So it's clearly a time of difficulty, and yet all three portfolios have not only delivered stock price performance, Rakshit spoken about that, but also earnings, market share gains, revenue growth, and earnings. So if you look at, say, the LCP portfolio, and by the way, just to be clear, we've stopped taking flows in Little Champs 3 months ago, but the portfolio continues to compound at a great rate because of fundamental performance from these companies. So if you look at LCP, whether you look at, say, a company like Amritanjan, who's delivering sparkling growth in free cash flows, business is holding up. Amritanjan, for those who are unaware, sells balms and pain relief remedies with a very strong franchise in South India and Eastern India. So company has also moved very successfully into the sanitary napkins market, which was historically a oligopoly dominated by two MNCs. Amritanjan has come with a disruptive model and doing ever so well in the sanitary napkin market. So Rakshit made the point around FMCG companies. Amritanjan is an FMCG in the Little Champs portfolio, which has gained market share. We've seen companies like GMM Pfaudler, we've seen companies like Alkyl Amines announce bumper results. We're talking about profits growing at 30-35% through COVID. Their order books are full. Divi's Lab and CCP is booming. Divi's Lab procures raw materials from alkyl amines, and both alkyl amines and Divi's Lab procure their glass-lined reactors from GMM Pfaudler. Their entire industry has, blockbuster order books, and they're driving earnings growth there. Similarly, if I look at, say, a small cap financial stock like Mass Financial, that sits inside Little Champs, Mass Financials is reporting that recoveries are back to 90-odd%. Not quite HDFC Bank level, but better than 99% of NBFCs out there. Like Bajaj Finance, Mass Financial has a very strong balance sheet, 25%, in fact, more than 25% capital adequacy. Even after provisioning properly for COVID, Mass Financial is in sparkling shape to gain market share. And if we finally look at Kings of Capital, we launched Kings of Capital middle of July. I was investor number 1. We've had around 200 odd clients who put in money there. Kings of Capital, as of yesterday, has compounded, just raw compounding. I'm not annualizing it. Just raw compounding in 3 months has been around 25%, driven not just by frontline stocks like HDFC Bank and Kotak Bank, but also driven by companies like AU Small Finance Bank, which we reckon is one of the better smaller banks in the country, and doing really, really well in the rural Indian context. Interestingly, one of the big planks of Kings of Capital is exactly what all of us are doing on this call, which is the savings play. Around 40-45% of Kings of Capital are asset managers, life insurers, general insurers, and for understandable reasons, these companies are seeing very good flows. Life insurers and general insurers are obviously seeing bumper flows as people realize the importance of buying health insurance, buying life insurance, and more generally, as Indians realize that buying flats and bars of gold are not going to take them anywhere, massive flows into the financial system, and the Kings of Capital are benefiting from it. So the same compounding dynamic operates there. I remember in February, March, when Little Champs fell, so January, February, March, CCP fell 12.9%. And Little Champs, I think, fell around 25%. By March, and a lot of clients were, shouting at us saying, portfolios corrected, what will happen? Little Champs recouped the lost ground in, I think, no more than 3 months. In 3 months, Little Champs pulled back the January, February, March correction. Rakshit, how long did it take CCP to pull back from the Jan, Feb, March correction?
So to go back to so by August mid, we were back to levels of early Jan when the markets peaked.
So CCP took 5 months, Little Champs took 3 months. And the reason these companies are pulling back, folks, is not because Rakshit, Pramod and I are going on TV and talking it up, right? It's because these companies are producing earnings growth. As Rakshit showed you in the CCP's case, as our newsletters on LCP keep telling you, they're producing earnings growth, which is eye-wateringly strong. The earnings growth is dragging these companies out of the COVID correction. The earnings growth in turn is driven by market share gains. So Amritanjan is gaining market share in the pain relief space. In CCP, Nestle is gaining market share in the food industry. And that's the way one needs to invest in a country like ours, where the overall economy is a $3 trillion, 5th largest economy in the world. The overall pie is massive. What all of us need to do is invest in companies who keep eating up a bigger and bigger slice of the pie. And if we do that, if we invest in companies across our 3 portfolios, we've got around 30 to 33 stocks. These 30 to 33 companies account for something like 75-80% of the profits in our entire country, right? If you add up the Marcellus portfolios, CCP, LCP, and KCP, Kings of Capital, you're looking at companies who account for something like 80% of the profits of the entire economy. There are 6,000 companies listed. There are, I think, registered in the ROC several crores of companies. Of those several crores of companies, 30-35 companies are driving 80% of the economy's profits. Those companies sit in Marcellus's clients' portfolios. And in that context, we are giving you guys an opportunity to invest in them through, you can come in and do the one-shot investment. But if you're kind of, what should I say? The heart is willing, but the mind is willing, but the heart is weak. The mind is willing, but the heart is weak. Your heart is pounding that much harder when you think about putting in 50 lakhs into Marcellus's portfolios. We're giving you the STP option, where automatically you're spreading the investment out over 5 months.
Thanks, Saurabh. So Rakshit, I think we should take on this question, as your slide shows that CCP has underperformed the Nifty YTD, and some of our clients have said that their personal portfolios have done better during this period. How do we explain this?
Yes. So, okay. Again, if you go back to, first of all, the longer history over the last 30 years, there have always been 12-month periods lasting for around, so in 5% of the historical timestamps, consistent compounders do underperform, right? But whenever they do underperform versus the benchmark, the absolute performance is healthy enough. Why do they underperform? The reason always is around non-fundamental factors taking the market up or certain stocks up. Just to give you an example, between 2005 and 2007, during those 2 years, L&T became 10 times in 2 years, right? And I'm not exaggerating. This really did happen in front of all of us. L&T, a Nifty 50 company, became 10 times in 2 years from 2005 to 2007. If any client had L&T in their portfolio, then they certainly outperformed any CCP type of a portfolio, right? The flip side is that this happened, latching on to an L&T in 2005 to 7, or latching on to a Reliance Industries from April 2020 to June 2020. These are opportunities that come once in 5 years, once in 10 years. People who don't have hand of God on the head cannot consistently lap up these opportunities, right? And hence, it more than neutralizes the moment you extend the time period to say 2 years or longer. The 6-month underperformance more than neutralizes. The point that any client should be concerned about in CCP, if it happens, is if CCP's profit compounding underperforms Nifty's profit compounding, because then the underperformance at a share price level is going to be permanent. If CCP's profit compounding significantly outperforms Nifty's profit compounding, which is what has happened over the last 6-12 months as well as over the last 5 years, then any underperformance at a share price level is going to be temporary, will last for maybe 3 months, maybe 6 months. We are not in a rat race. We are not trying to deliver the best return to the client, and the client should also not try to be the fastest compounder in the country at any time period, right? You need healthy and low volatility of compounding. Only then will you compound your wealth. You're not going to compound by being the best in your society or the city or the country, right? So that's how I would put it.
Fair point. Just one clarification, Rakshit, worth giving is your analysis at the portfolio level, not at the stock level, because somebody is very, very perfectly pointed out, and it's astonishing. Page Industries, exactly this time 3 years ago, the stock price was exactly very close today, right? Therefore, the returns from Page Industries has been zero over a 3-year time frame.
Correct. The same has applied to, by the way, Asian Paints few times in the past, right? So let me take you to the Asian Paints chart. So look at the 12-month performance, negative from December 08 to August 09. Obviously, that was a crash. Even if you look at, let's say, every once in a while, a 12-month period has been coming over the last 5-6 years, where consecutively for 4-5-6 weeks, a 12-month period of Asian Paints has delivered nothing, right? So this happens to every stock. In our book, Coffee Can Investing, we have actually quantified this, that whether you look at Page Industries, and we, I think, took Page Industries as an example in the book before Page stopped compounding, or whether you look at Marico, whether you look at Asian Paints over a 5 or 10 year period, for 40 to 60% of the time period, the stock compounds at a healthy rate, healthy being, let's say, more than 15-20%. For 30 to 40% of the time period, the stock does not compound at all. And then for the remaining 10, 15, 20% of the time period, the stock does whatever, 5-10% compounding. So this is not uncommon. Page is not the first stock. Just to also highlight, for instance, we've held Dr. Lal PathLabs for 4 years now in our portfolios. I mean, 4 years as in Marcellus Plus, where we used to manage money before this. And Dr. Lal PathLabs, between the time period when we started buying it, which was March, April 2017, and December, Jan 2018, 2019, so December 2018, Jan 2019, during that 2 year period, Dr. Lal PathLabs only went southwards as a stock price, right? Partly because its fundamentals were getting weaker in the run rate of compounding. And that was partly because of the external factors which related to a massive price war that led to price hikes being curtailed and actually price cuts being taken and a few other things. This is not a Page specific thing. What is a justified question is, why has Page stopped compounding its earnings over the last 18 months? I think that's a better question to ask, not the share price. The share price will keep happening, and be ready for it. Asian Paints probably will remain at 2200 for the next 24 months. God knows, right? So we should not worry about that. Now, why has Page stopped compounding earnings over the last 18 months? Do we see that as a permanent or a temporary period? Our understanding of the situation is that yes, there was a macro factor responsible for all innerwear companies, all textile companies facing a challenge because of channel issues. But in addition to that, there was also a bit of a reset which was happening internally in Page Industries, is agility to respond to such a macro challenge. Typically, we would like a CCP company to be very resilient to such macro challenges. And as I said, instead of a 25% CAGR, you're okay to come down to 20 or 15. But instead of 25, you come down to 5 or 0, right? Means there was no resilience. And there were some, I would say, certain things which we've identified in hindsight. Obviously, 12 months back, we identified what happened in FY19. In hindsight, we identified. But the good thing is, the good news is that we see a lot of changes happening at Page in that specific area. And this area was predominantly around sales. Product was secured, always a moat, continued to be a moat. Manufacturing was secured. The brand recall was secured. There was a few issues in sales which they've rectified. They've not lost market share. Jockey has not lost market share beyond, say, a few basis points to someone like a Van Heusen, that too for a temporary time period. That competition has become benign over the last 12 months. But we are quite confident that Page is still a consistent compounder. The moat is intact. The growth will be back. Had COVID not happened, the growth had started coming back. Now that COVID has happened, from August onwards, we are seeing that growth come back, and we are keeping a very close eye on how fundamentals evolve. Having said that, we will probably make one mistake at a time, and so far we've not had a mistake in the portfolio where we've been wrong in reading the fundamentals. But yes, maybe once in a while we might make mistakes. So far, Page Industries is not a mistake in our minds.
So Rakshit, can you just take us back to that P, A, B, bucket A, bucket C, A is for airlines, B is for Buffett, or a slider? There's a point I think that we can make here, which will help even non-Marcellus investors. So if you divide the BSE 500 into A, B, and C, there's around 20 Cs for CCP stocks in the country, and between KCP and CCP, we pretty much have all 20, right? And as Rakshit explained, every CCP stock will go through long periods of where it does nothing, right? In fact, when we have crunched the data, in a typical 10-year period, a typical CCP stock for around 5.5 years does nothing. But in the remaining 4.5 years, it gives you such bumper returns that in 10 years, you get 10x from each stock. So what happens is if you build a portfolio of 13 such Cs for CCP stocks, in a given year, 3 to 4 do nothing, 5 or 6 have a sparkling run, 2 or 3 have an in-between position. In the subsequent year, another 3 or 4 do nothing, another 5 or 6 have a sparkling run. But because your portfolio is packed with Cs for CCP, your outcome is a very consistent compounding in the 20% vicinity, right? So that's the world we play in. And as Rakshit said, we might have made a mistake somewhere where we have a stock which is not actually C, galti ho gaya. We have taken a B stock. We've taken a B's for Buffett stock, mistakenly assumed it's C's for CCP. But even if we make one mistake in a 13 stock lineup, if 11 or 12 fire for us, we're in good shape. Now, the challenge for most of you on this call, right, whether you're Marcellus clients or not Marcellus clients, at many levels, it's not really relevant. What most Indian H&Ws do is they'll have 3 or 4 mutual funds. They will have 2 or 3 PMSs. They'll have 1 or 2 AIFs. And as a result, they'll have typically, if you add up all of these things, they'll have around 200 stocks that they'll be owning, right? If you own 200 stocks, in those 200, you'll have 20 CCPs, but you'll also have something like 150 A's for airlines and around 30, 40 B's for Buffett's, right? And because the core of your portfolio is not C, right? You have the 20 CCP, but you have 180 other stocks. You have 180 other stocks who either have no compounding engine, A's for airlines, or they have modest compounding engines, the B's for Buffett, 12% style compounding engines. So most Indian H&Ws, the trap they fall into is they invest in Marcellus, but they go and invest in 6 other things, which completely drags down the compounding, right? And that in a way dilutes the good work that we are doing. You compound with us at a decent rate, all those charts Rakshit has shown you, but because you are let down by your A's for airlines and your B's for B portfolios, your overall compounding tends to be quite miserable, right? And that's the context in which we'll keep trying to bring you innovations so that you're able to give more of your portfolio to C's for CCP rather than getting your returns diluted by A's for airlines and B's for Buffett.
Great, fantastic. So I think we've covered most of the questions around the subject of timing the market, booking profits and stuff. I think one clarification we'd like to make is there's questions around, are we saying that there is absolutely no chance of a market crash? I think we have to clarify that nowhere in this whole 90 minutes we've mentioned that. All we've said is we have no idea. We have no idea. And the examples that Rakshit has shared, even through the market crash, you're better off if your investment horizon is 3 years plus, you will end up with a reasonably positive outcome. And a similar query, there is a fundamental question around STP where somebody said, is the launch of an STP an acknowledgement on our part of a potential volatility in the market in the near term? Again, the answer is absolutely no. We're emphatic in our view that if you are sitting on a lump sum amount of money, you better off deploying it straight away, right? We do not encourage an STP type of investment for rational reasons. And for those of you who are interested in the literature supporting that argument, please write into us. We're happy to provide you with extensive research over long periods of time. However, we do understand as human beings, we don't make all our decisions on a rational basis. There are emotional reasons why an STP is justified, simply because as Daniel Kahneman said in his seminal research a few years ago, that we operate on loss aversion. Nobody, while we might all like to say that we are all long-term investors, we don't mind short-term pain. Let's accept it. None of us like short-term pain in our portfolio. None of us like to see losses in our portfolio in the short term. For those of you who are in that bucket who would rather not lose some sleep in the short term, even if it means that you end up buying these stocks at a potentially higher price, you might get lucky in buying it at a lower price, but there's no guarantee as Rakshit has shown. For those, we have launched an STP as an option. You're still free to invest all your money in a lump sum even today, and that's what our recommendation remains. But for those of you who would rather sleep peacefully in the short term, the STP is a flexibility that we are offering. There are quite a few questions around STP. We have detailed, as you can see, the FAQ link here, as well as in the chat window that we've shared. All these questions are answered on our website. But Nitesh, are there any questions you reckon merits an answer on this call, or should we just point our clients to the website?
I think there are a couple of questions which are common, so I will quickly answer them, and then again all the answers are uploaded on our FAQs on our website. So we'll request everyone to refer them. So one of the common question is minimum amount in STP for new or existing client. It's 50 lakhs, irrespective you are new or existing client. Minimum amount to be invested via STP is 50 lakhs. Another question is, can we change the date from 20th? Can we make it 15 or 10 or 5th of every month? No, it's a plain vanilla option that we are offering. 20th is a fixed day where money will be transferred from liquid STP to the equity PMS. And another question, and the one last common question is high fees, or there is some confusion. So I had mentioned 0.3, 0.4 in the website. It's mentioned 1.5%. 1.5% is per annum. So this STP is for 5 months. So if we do some rough calculation, it will come anywhere between 0.3 to 0.4, depending upon when we start the STP. So 1.5% is per annum. That is mentioned on our website. Over here, it's 0.3, 0.4 for the 5-month time frame. And most of the questions, basic questions we have uploaded, as Pramod mentioned, on our website in FAQs. Please refer. And in case you still have any queries, feel free to reach out to us.
Just to add, everyone, we are going to be soon launching our systematic investment plan as well, where the one place where we believe in consistent investment is when you have a repeatable savings pile coming up, either because of your salary or your dividends, if you're a promoter, or whatever is your mode of income, a systematic way of saving is always recommended. So for those who are not sitting on a lump sum but are seeing periodic inflows over the next few months, quarters, years, you can sign up into that SIP. So watch this space, and we will do a similar webinar to explain the benefits of an SIP and the modalities of an SIP. But with that, I'll bring this call to an end.
I think just on that, worth highlighting, Pramod, almost all, not almost all Marcellus staff, all our monies are invested in our funds, right? And wherever possible, we've gone in all in one shot, right? But as Pramod is saying, we are also salaried employees. So whenever our savings, we have a surplus in our savings, we go in and put extra money into Marcellus's PMSs. We would love to know from you whether there are other good fund managers in India. But so far, we have found that investing our hard-earned money in Marcellus's PMSs have been the way forward. As you pay us fees, that gives us, we earn from that. And as we get surpluses, we reinvest. And that's where the SIP becomes very useful. And we realize the utility ourselves because, we're not sort of descendants of rich people. Our fathers, mothers did not give us vast sums of money to deploy. So as we've earned money, we have topped up consistently in Marcellus's products, and we thought others out there might want to do so.
Thank you. Thanks everyone for dialing in. Appreciate very, very interesting questions. And for those of you which we couldn't find the time to answer, we will reach out to you as always and write in, especially for our clients. Thank you very much.
Thank you.
Thank you.